You're sitting at your kitchen table on a Sunday night, staring at your bank account, and you're genuinely confused. You made decent money this month. Maybe not amazing money, but decent. Enough that you shouldn't feel this tight. And yet, the numbers don't add up. There's less in there than there should be, and you have no idea where it went. You're not blowing money on luxury vacations, you're not buying designer clothes, you're not doing anything crazy, and that's exactly the problem. Because the money mistake nobody talks about isn't the big, obvious stuff. It's the quiet, respectable-looking thing you've been doing that feels completely responsible. My name is Ben, and I spend way too much time thinking about the gap between what people earn and what they actually keep. If you're someone who feels like you're doing the right things financially but still can't seem to get ahead, you can't seem to grow your savings, and you feel like your money just disappears every single month, make sure to hit that subscribe button and give this video a thumbs up if this ends up helping you out. Because today, we are going to dig into something that most financial content completely skips over, and once you see it, you won't be able to unsee it. Okay, so here's the thing. Most financial advice out there is focused on two things: spend less or earn more. And look, those things matter. I'm not going to sit here and tell you that spending and income are irrelevant. They're obviously not. But here's what most people don't realize. A huge portion of people who struggle financially aren't struggling because they spend recklessly. They're struggling because of something way more subtle. They're making what I call the almost right mistake. And the almost right mistake is this: they're saving money, but they're saving it in the wrong place, for the wrong reasons, at the wrong time. And because it looks like the right thing to do, nobody questions it. Let me explain what I mean. According to the Federal Reserve's 2023 Survey of Consumer Finances, the median American household has about $8,000 in their savings account. $8,000! And on the surface, that sounds reasonable. That's a few months of expenses, right? But here's the kicker. That same survey found that the average savings account in America is earning somewhere between 0.4% and 0.6% in interest per year. Meanwhile, inflation over the past few years has been running anywhere from 4% to 8%. So in real terms, that $8,000 sitting in a standard savings account is actually losing purchasing power every single year. People feel like they're doing the responsible thing by saving, and in a very literal sense, their savings are quietly shrinking. Now, I know what you might be thinking. Ben, at least they're saving something. Isn't that better than nothing? And yes, technically, having $8,000 saved is better than having zero. But that mindset, at least I'm doing something, is exactly the thinking that keeps people stuck at the same financial level for years. Because there's a massive difference between saving money and building wealth, and most people have been taught to do the first one without ever being shown how to do the second. Here's where it gets really interesting. The reason this mistake is so common isn't because people are lazy or irresponsible. It's actually the opposite. The people who fall into this trap are usually the ones trying the hardest. They grew up being told, save your money, don't spend what you don't have, be responsible. And that advice came from a good place, but it came from a generation where a savings account actually paid you something meaningful. We're talking 5%, 6%, even higher back in the 80s and early 90s. Parking money in a savings account used to be a legitimate financial strategy. It's just it hasn't been for a very long time, and nobody updated the advice. There's also a psychological thing happening here that's worth talking about. Behavioral economists call it effort justification. The idea that when we put effort into something, we assign it more value than it might actually deserve. So when someone works hard, cuts back on eating out, skips the vacation, and puts $300 a month into a savings account, they feel accomplished. And they should feel some level of accomplishment, honestly. The discipline is real. But the emotional reward of feeling responsible creates a blind spot. It becomes very hard to question a behavior that you've already associated with being a good, responsible adult. And so people keep doing it, month after month, year after year, without ever stopping to ask, is this actually working? Think about it this way. Imagine you spent 6 months training for a race. You wake up early, you run in the rain, you make sacrifices, and then on race day, you show up and someone tells you, "Oh, by the way, the finish line is 3 miles further than you thought." That's frustrating, right? But it would be way more frustrating to keep running the same route for years, feeling proud of the effort, and never realize that you weren't actually getting to the finish line. That's what's happening financially for millions of people. The effort is real, the discipline is real, the destination just keeps moving further away because the vehicle they're using can't keep up.
All right, let's get into some actual numbers here, because I think this is where things really click. Let's take two people. Call them Marcus and Diana. They're both 35 years old, both earning around $60,000 a year, and both managed to set aside $500 a month. Same income, same savings rate. The only difference is where they put it. Marcus does what he was taught. He puts his $500 every month into a regular savings account, earning about 0.5% interest. He's consistent, he never misses a month, and he feels good about it. After 30 years, when he's 65, Marcus has saved $180,000 of his own money. With that tiny interest rate, he ends up with roughly $187,000 total. That sounds like a lot until you remember that $187,000 in 30 years, accounting for even moderate inflation, has the purchasing power of maybe $80,000 or $90,000 in today's money. He basically worked for 30 years of disciplined saving to end up with less than half of what he thought he was building. Diana does something different. She puts that same $500 every month into a diversified index fund, the kind that tracks the broad stock market. Now, past performance doesn't guarantee future results. I want to be really clear about that. But the S&P 500 has historically averaged around 7 to 10% annually over long time horizons. Let's use the conservative number, 7%. After 30 years, Diana ends up with approximately $567,000. Same $500 a month, same discipline. The only difference is where the money went. That's not a small gap. That's the difference between a comfortable retirement and a stressful one. That's the difference between having choices at 65 and not having them. And look, I'm not saying the stock market is guaranteed. I'm not saying you should dump your emergency fund into volatile assets. What I am saying is that understanding the difference between these two paths and making a conscious, informed choice about where your money goes is one of the most important financial decisions you can make. Most people never make that decision at all. They just default to what's familiar, and familiarity in this case is costing them hundreds of thousands of dollars. Here's what most people don't realize, though. This isn't just about savings accounts versus index funds. That's part of it, but the deeper mistake is actually about sequencing. It's about the order in which people prioritize their money moves. And this is where I see smart, educated people get tripped up all the time. A lot of people, when they start getting serious about money, try to do everything at once. They want to build an emergency fund, pay off debt, save for a house down payment, start investing, and maybe save for their kids' education, all simultaneously. So what happens? They spread $500 thin across 5 different goals and make almost no progress on any of them. 3 years later, they have $2,000 in 5 different accounts, and they feel like they're behind on everything. And financially speaking, they kind of are. Not because they did anything wrong, but because nobody ever showed them the sequence. Think about it like building a house. You don't start putting up walls before the foundation is poured. You don't install the roof before the frame is up. There's an order to things, and when you do them out of order, everything takes longer and costs more. The financial sequence that makes the most mathematical sense for most people looks roughly like this. First, a small emergency buffer, even just $1,000, so unexpected expenses don't derail everything. Then, if your employer offers any kind of retirement match, you capture that first, because it's literally free money, and there is nothing in personal finance that beats a 100% instant return. Then you address any high-interest debt, because paying off a debt charging you 22% interest is equivalent to getting a guaranteed 22% return, which you will not find anywhere else. Then you build your full emergency fund, and then you start investing consistently and aggressively for the long term. Most people skip straight to the end, or they do step 5 before step 3, and wonder why they still feel financially stuck, even when they're technically doing all the right things. The sequence matters enormously, and almost nobody talks about this clearly. Now, here's the part that honestly keeps me up at night a little bit, and I think it'll resonate with you too. There's an invisible tax on waiting, and it's probably the most expensive tax you'll ever pay because you'll never see it on a statement. Here's a concrete example. If you invest $10,000 at age 25 and you never add another dollar, just let it sit in a diversified investment at 7% average annual returns, by age 65, that $10,000 becomes roughly $149,000. You didn't do anything. You just started at 25. Now take that same $10,000 and imagine you waited until 35 to invest it. Same conditions, by 65 you have about $76,000. You waited 10 years and it cost you $73,000. You didn't do anything wrong in those 10 years. You were just living your life, paying rent, handling your responsibilities. But the cost of that delay is more than 7 times your original investment. That's the invisible tax. And the hardest part about this is that the years between 25 and 35 are genuinely hard. Rent is expensive. If you have kids, childcare is expensive. If you're paying off student loans, that's real. If you're in a lower income job trying to work your way up, I get it. I'm not dismissing any of that. But even if the amount is small, even if it's $50 a month or $100 a month, the act of starting creates a habit, creates a system, and gives compounding the time it needs to do its job. Starting small and early beats starting big and late almost every single time.
Now you might be thinking, Ben, this sounds good in theory, but the market crashed in 2008. The market crashed in 2020. What if I invest and the market tanks right when I need the money? And that's a fair concern. It's a really fair concern. But here's the thing. Market crashes are terrifying in the moment and almost always temporary over long horizons. Someone who invested consistently through the 2008 financial crisis, the 2020 COVID crash, and every dip in between, and didn't panic and sell, is doing very well today. The people who got hurt were the ones who either needed the money short-term or who panic sold at the bottom and locked in their losses. This is why the sequence matters so much. You don't invest your emergency fund. You don't invest money you need in the next 2 or 3 years. You keep short-term money safe and liquid, and you let long-term money work. The market being volatile in the short term is not a reason to avoid it for the long term. It's actually the reason returns are higher than a savings account. You're being compensated for tolerating that short-term discomfort. There's also the objection that goes, I don't know enough about investing to start. And I hear that. It's real. But here's what's funny. You don't need to know that much to get started. A simple, low-cost index fund requires almost no expertise. You don't need to pick stocks. You don't need to follow earnings reports. You don't need to time anything. The entire premise of index investing is that you buy a tiny slice of hundreds or thousands of companies and you hold it. That's it. The complexity that people imagine is required to invest is largely an illusion built by a financial industry that benefits from you thinking you need their help. All right, so let's make this practical, because I don't want this to just be an interesting video you watch and forget. I want you to actually do something with this. The first thing to do today, not next week, is figure out where your savings actually are and what interest rate they're earning. Log into your bank account and look it up. If it's under 1%, you need, at minimum, to move that money to a high-yield savings account. In 2024, there were plenty of high-yield savings accounts offering 4 to 5% for emergency fund money. That's not investing. It's still fully safe and liquid. It's just not leaving money on the table unnecessarily. The second thing is to find out if your employer offers any retirement matching. If they match, say, 50% of contributions up to 6% of your salary, and you're not contributing at least 6%, you are leaving free money on the table every single pay period. This isn't even debatable. Capture the full match before you do anything else with your investment dollars. The third thing is to get honest about your sequencing. Write down the financial goals you're currently working on and put them in order of mathematical priority.
Not emotional priority, mathematical priority. Which debts have the highest interest rates? Where is unmatched free money sitting? What's your current emergency fund situation? Get it on paper, put it in sequence, and stop trying to do everything at once. And the fourth thing, start investing for the long term, even if the amount feels embarrassingly small. Open a brokerage account or contribute to an IRA. Pick a simple, diversified, low-cost index fund and automate a contribution even if it's $50 a month. The habit matters. The system matters. The compounding starts from day one, and there is no day that is better to start than right now. Look, I want to be straight with you about something. None of this is complicated once you see it clearly. The math isn't hard. The steps aren't hard. What's hard is unlearning the advice you've been given for most of your life, the advice that was well-intentioned but slightly outdated. What's hard is overcoming the emotional satisfaction of doing the safe thing when the safe thing might actually be the thing holding you back. What's hard is starting when you feel like you don't have enough, don't know enough, or haven't figured it all out yet. But the truth is, you don't need to figure it all out before you start. You just need to start. And the fact that you're sitting here watching a video like this, asking questions about your money, thinking critically about whether what you're doing is actually working, that already puts you ahead of most people. Most people never ask the question. They just keep going until one day they look up and realize the finish line moved. You're asking the question. Now, go do something with the answer. Subscribe to this channel, and I'll see you in the next one.